Good morning. Thank you for joining Bowers Company CPAs today. My name is Bill Doolittle. I'm Director of Marketing. And today we are going to review a section of the Coronavirus Aid, Relief, and Economic Security Act, which we are calling the CARES Act. And that section is the Paycheck Protection Program. Speaking today is from Bowers will be Bob Teska, who's a partner with our firm. As Bob goes through his presentation, if you have a question, please enter it in the questions section on your GoToWebinar control panel and send it in. And then at the end, I'll be coming back on the line and we'll try to go through as many as we can in the time that we have. We will be sending the slide deck out to attendees, so look for that. And afterwards, we would also be posting the actual presentation on our website. With that, we are going to start, and I'm going to ask Bob to jump in, and he'll start the presentation.
Hey everyone, just want to thank you for joining us today. I hope you find the information we provide here useful and also helpful in these what we would definitely call unprecedented times. I'm sure, like a lot of you, you're working from home, so am I at this point, hoping the audio connection is working well for you. I'm sure also a lot of you have adopted the business comfy attire at home. I'm not sure I'm going to want to go back to the office after a couple weeks of this, but we'll do what we have to. So let's kind of jump into this. Just as kind of an outline for what we are going to go through before we get into this one slide here, we're going to go through an overview of the plan, the potential loan size with its allowable uses, its eligible and ineligible payroll costs. We're going to look at loan terms and requirements. We'll look at how you calculate your loan forgiveness, and I have a couple of examples there that we can look at. And then some of our general comments and observations on how we view this program. And then I will say kind of just on the outset, there's still a little bit of ambiguity in some of the provisions of this. So as we go through this, I'll point those out to you. We're hoping to get additional clarification from the SBA. Like I said, some of this could change slightly. And I'll also say just in talking to banks, each bank, there's guidelines put out from the bill and then further clarified by the SBA, but each bank is requesting different documentation. So there's, one bank might want certain payroll reports, whereas another bank might be requesting something else. So it's going to be important that you work with your bank to find out exactly what support they're going to want to support your loan application. All right, so let's get into this here. In looking at this at broad strokes, you have to understand that this bill was passed for two primary purposes. The first one is the federal government wanted you to be able to retain your employees. A lot of people have had to cut people's hours. In a lot of cases, people have been furloughed or laid off and they're on unemployment. So one of the driving forces behind this bill is they wanted you to be able to get your employees back on your payroll to retain them so that when the economy's turned back on, so to speak, you're able to pull these people off of your bench and get right back to work. And the other piece of this, or the primary purpose, was to put money in employees' pockets so that they can buy things and stimulate the economy. When you look at this bill, that really is the driving force behind it. It's to stimulate the economy and to get the engine running again. They allocated $350 billion toward just this one piece of the plan. That number should equate to about 2 months of payroll for companies with under 500 employees. That was how they benchmarked this. The loans themselves, just looking at this high level, are 100% federally guaranteed, which means that there's no credit risk to the participating banks. Because of that, there should be a lot of banks, and there are a lot of banks that do want to participate in this. As we said, the objective is to help you maintain your payroll. If you follow the provisions in this, the loan will be forgiven. There's no SBA fees, and the program is going to run through June 30th. The general requirements to participate in this are as follows. You have to be a business or an entity that was in operation as of February 15, 2020. You need to be a small business or certain not-for-profits, so 501c3s and 501c19s only. There's other not-for-profits that fall under different sections of the 501c's code that this is not applicable to. It also includes individuals operating as sole proprietors, independent contractors, and other self-employed individuals, also tribal concerns. And then another determining factor is you have to have less than 500 employees. There are certain instances, especially in like the restaurant world, where you might have multiple locations and you might have more than 500 employees. It's going to be measured at the by location, and there's certain industries that have an NAICS code that typically start with 72, where you might be able to be eligible if you have more than 500 employees, but you're going to have to search that out a little bit. We did get guidance from the SBA that this program is going to be good to go on Friday. A lot of banks are going to be doing the loan application process 100% online. You're going to download the application from there, fill it out, and upload the supporting documentation. So that's going to be available on 4/3 for small businesses. On 4/10, which so a week after that, they're going to open it up to the independent contractors. All right, so obviously one of the big questions is how large of a loan can you get, and what are the allowable uses for that loan? So the loan size is determined by your average monthly payroll costs incurred in the 12-month period before you apply for the loan. So you'll aggregate all of your allowable payroll costs over that 12-month period, divide by 12. You come up with an average monthly payroll cost. You'll multiply that by 2.5, and that's going to become your maximum loan value. That value is going to be limited to $10 million. So if that calculation led you to $12.5 million, the max loan value would be backed up to $10 million. Allowable uses for the proceeds include eligible payroll costs, which we define on the next slide, payments of interest on existing mortgage obligations as of the date of the loan, so they had to be in existence already. Rent, that you have to have an actual lease agreement with it. It can't be something where it's a month-to-month agreement with a related party. There actually has to be a formal rent agreement. And then utilities, which is going to include your gas, electric, internet, telephone, those sort of overhead type expenses. And then there's certain other interest obligations from loans that existed, the proceeds could be used on. And just note that if you're a seasonal business, there are special dates, periods that they use to calculate your loan size. All right, so what are your eligible and ineligible payroll costs to calculate your loan size? Well, it's going to start with wages, salaries, and commissions that you're paying your employees. Any vacation time, parental leave time, sick time, medical time, that's all going to go into this bucket. Allowance for dismissal, so that includes any severance packages that were paid out. Group health benefits, including the premiums that you would pay on behalf of the employees. Retirement benefits that were paid, and then the state like unemployment type taxes that you paid on these wages. And I've had quite a few questions on, especially like the health benefits. Does it include just the employer portion and any employee portion that they might contribute? It's only the employer cost. So if you pay half and the employee pays half, it's just going to be the 50% included that the employer pays. And the same thing with the retirement benefits. It's not going to include. It's just the employer portion that is included in this calculation. Ineligible payroll costs, stuff that you're going to have to back out, is going to include any wages in excess of $100,000. So if you have an owner that's making $140,000 a year, you can include the $100,000, but the $40,000 has to be backed out. The employer side of payroll taxes, those aren't going to be included here. compensation for anyone who is paid outside of the United States. So if you've got someone that you're paying outside of the U.S., those wages have to be backed out. And then if you've taken advantage of the bill that was passed a couple weeks ago, the Families First Coronavirus Response Act, and you're receiving credits under that, those would also have to be backed out. So you aggregate all these costs, subtract out the ineligible piece, divide by 12, comes your monthly average monthly payroll, multiply that by 2.5, and that becomes your maximum loan value that's available to you. So the loan terms and the requirements. There is the application has been finalized, and it is floating out there on the internet. You can find it if you search PPP loan application. It's a 2-pager. There's some financial information at the top and then some questions to answer down below. So one of the big things you have to do is make a good faith certification that your business has been affected, which quite honestly, at this point, I can't think of too many businesses that have not been affected by this. Even businesses that are considered essential have been affected. I can speak just from our accounting firm. Accounting is considered essential, but we have people that are working from home that haven't worked from home. It's inefficient. We're certainly not producing the way that we used to. I talked to some clients that work in the trucking industry. They're considered essential and they're still working. However, the businesses that they used to deliver freight to are closed down, so they can't deliver freight there. So the loads that they're shipping are being reduced. And then some of my clients have FedEx lines, and you would think, oh, FedEx, that's got to be great. However, half the FedEx line was shipping to companies again. So, that part of the line has decreased significantly. So there's not too many businesses that aren't going to be affected through this crisis. Maybe grocery stores. They might be the one place that isn't all that affected by this. You have to use the funds for qualified expenditures, and you have to certify that you don't have any pending applications for the same purpose. So if you're looking at applying to multiple SBA plans, you've got to make sure you get some consultations and make sure you're following the rules associated with how many loans you could have outstanding in the timing of when those applications should be in. So the additional terms for these loans, this is pretty exciting. There's no guarantees, personal guarantees required for these loans. The SBA will not take any collateral. These are non-recourse loans, so they can't come back on individual shareholders. And then there's no fees. So the bank won't be charging the typical SBA fee for these loans. However, the SBA will be paying that fee on your behalf to the participating bank. There's deferment of these loans off the back for 6 months with no interest and no payments. Interest does accrue, but the thought is that you will get this loan forgiven before the 6-month period is up. So there should be no payment due at all. The initial guidance said that it would be not more, the loan terms would be a maximum of 10 years with a maximum interest rate of 4%. The guidance that came out from the SBA said that the loan term is going to be set at 2 years with an interest rate of 0.5%. So if you do end up with a portion of the loan that's not forgiven, the term is going to be for 2 years, and the interest rate on that is going to be 0.5%. Again, there's no fees associated with this, and there's no prepayment penalties if you were to, pay it all off in one lump sum. So the loan forgiveness, this is, obviously where a lot of questions are surrounded. There's a 2-pronged test for this, and this is where I've got a couple of examples we can look at. There's the first thing they look at is, did you take the proceeds and did you use them on qualified expenditures? So those qualifying expenditures, again, being wages, health benefits, retirement benefits, and then your overhead costs, rent, lights, phone, and such. So if you got a $200,000 loan and they measure how you use the proceeds from 60 days after you receive the proceeds. So if we got the loan tomorrow on Friday, they would say, okay, 60 days forward, we're going to check and we're going to see, did you spend the loan proceeds on qualified expenditures during that time? And if we did, then, we make it through test 1 without any of the loan proceeds being excluded from forgiveness. And then we go on to test 2, which is a head count. And they look at the head count that you had before this pandemic occurred to the 60-day and compare it to the 60-day period the 60-day period after you receive the loan proceeds. And if it's a 1-for-1 ratio and you've spent all the loan proceeds on qualified expenditures, then the loan would be 100% forgiven. You get to choose what period they look at before the loan, and it's either going to be the period of February 15, 2019 through June 30th, 2019, or January 1st, 2020 through February 29th, 2020. And you would want to select the loan or select the period that has the least amount of full-time equivalent employees. So to kind of put numbers to that, so in this example, on the left-hand side of the slide, if you got loan proceeds of $1 million, we would look at our qualifying expenditures. So these are going to be expenditures during the 60-day period after receiving the loan. We had $800,000 of wages, we had health insurance premiums, retirement contributions, we had rent, and then some utilities. So we spent $1,010,000 on qualified expenditures. So we used all the loan proceeds and then some on qualified expenditures. So there'd be nothing from this test that was excluded from being forgiven. And then we'll look at the head count test on the right. And so we had 100 full-time equivalent employees in the 60 days after receiving the loan. And we're going to compare that to one period in the before we received the loan proceeds. So you're going to want to select the period with the least amount of employees. So in this case, it's going to be the February 15th to June 30th. So it's 100 divided by 100. Our ratio is 1. So we have a 1-for-1 ratio there. So in this case, we passed both tests and 100% of our loan would have been forgiven. In the next example, same thing in the use of proceeds test. We got $1 million of proceeds and we've used them all. So we spent our $1 million on qualifying expenditures. So then we move on to the head count test. And in this instance, we've got full-time equivalents of 93 in the 60 days after receiving the loan. And we're going to compare that to the lesser of the two periods, and that's still going to be February to June, and that's going to be 100. So 93 divided by 100 is going to be 93%. So we did pass the use of proceeds test, but we didn't maintain a 1-for-1 ratio of head count. So only 93% of our loan is going to be forgiven in this case. So $1 million multiplied by 0.93 is $930,000. So the amount we would have to be repaid in this instance is $70,000, and that would be termed out over 2 years at a 0.5% interest rate. Again, you can prepay it. You can pay it over 1 year or the full 2 years. You can pay it off all in 1 month. There'd be no prepayment penalty. Some of the questions I've gotten on this is, all right, I've laid people off already. What do I do about bringing them back? So in that instance, the bill says that if you have laid people off before you receive the loan proceeds and you bring them back at any point during the 60 days after receiving the loan proceeds, they would be counted as if they were there the whole time. So you get the loan proceeds today. A week from now, you bring everyone back. It would be as if they were all there. The thing you have to worry about is getting them back soon enough so that you can use all the loan proceeds on qualified expenditures, which the vast majority of it is going to be in wages. So you're going to want these people on the payroll as soon as you can get them. For contractors that I've talked to that have already laid people off, we've talked about bringing people back, and in most cases, or in a lot of cases, these contractors aren't considered essential, the jobs that they're on. So they're going to be paying guys to be at home, but they're doing that as a defensive position so they can keep the guys on their roster and they don't lose them to another contractor that might go back to work first. Maybe their jobs get approved to be worked on sooner than somebody else, and they want to lock their guys in, so they're trying to protect themselves. And then just some general comments and observations about this. We really believe that banks are going to be inundated with requests. This isn't a program they were expecting. They certainly haven't had time to gear up for this. In the talks that we've had with different banks, they're as stressed out about this as I'm sure you guys are, as we have been trying to understand it. But they've got to be the ones that actually handle the loan processing. So they are stressed to the max about this, and they're doing their best to get systems in place to handle this. Some of the bigger banks we've talked to are going to be 100% online. Some of the other ones, there's going to be a paper portion to it. This is broad eligibility. It's straightforward underwriting, 100% guaranteed, which makes it very appealing to the banks to provide this service. And because of that, the demand should be very high. The Treasury came out with some guidance, and they said that they expect the subscription rate to this to be very, very high. And they encourage people to apply for this as soon as they can. We've been encouraging our clients to do the same thing with that. Assuming that a business can provide a good faith certification, which we talked about, I really believe most businesses are going to be able to do that. At the firm, we don't see a downside of this because even if you don't get 100% of the proceeds forgiven, there are going to be a good portion forgiven, and that portion that's forgiven is going to be tax-free. And that's probably one of the biggest benefits to this, that the amount of the loan that's forgiven isn't taxable to you. Contact your bank or another SBA certified lender as soon as possible. So if you haven't done that already, you want to reach out, let them know you're interested in this. Because I alluded to, that each bank seems to have a different requirement for, while the application is the same, the supporting documentation they want seems to vary a little bit, and you want to make sure that you get everything to your bank in the order that they want it. If you happen to bank with a bank that isn't participating, because this is being rolled out first to SBA approved lenders, some banks have said that they're going to take care of their own clients first, and if there's funds left over at that point, they might look at helping additional people. So if your bank, if you're on the outside where you're working with a bank that isn't participating here, you could look at an organization called Pursuit. It's formerly known as the NYBDC. You can check them out at pursuitlending.com. They're an affiliate with the SBA and are facilitating loans through their organization. And then, as I alluded to also before, for companies that are currently shut down or you have furloughed employees, it's going to be essential that you manage the timing of bringing people back so that you have the expenditures to qualify for the tax-free loan forgiveness. And the other, the other option, or another thing that's I would say is that feel free to use us for a resource to assist you with your loan applications. We can check your calculations, make sure that the calculation is correct and you're maximizing the benefit that is allowable to you. So I think with that, we're ready for questions, Bill. So if you have any in the queue, I will take them.
Okay, we do. Some of them, you've touched on certain points of this during your presentation, but I'm just kind of going to go from top to bottom, and maybe you can just touch it again on those. So the first one is, we are a seasonal business. Currently, all employees are laid off until around the end of April, 1st of May. How will this program work for us, especially if we can't afford to rehire employees once we need them back to work?
All right. So I guess with a seasonal company, they're going to look at your headcount from February 15th to June 30th. So it's a slightly different time period. And they're going to compare that to your headcount in the 60 days after you receive the loan. So hopefully, I don't know what season you're working. I'm assuming it might be some kind of golf course or something where you're going to be getting people back to work here shortly. So you should be able to pair up your headcount from, like I said, June 15th of last year to 6/30 to what you should be bringing back on board.
Okay. Next one, is it best not to lay off people at this stage?
Repeat that for me, Bill.
Is it best not to lay off people at this stage?
That's going to come down to your cash flow. So if you've got the cash flow to keep people on, and you want to do that, you can fund this through your cash flow for the time period between now and when you get the loan proceeds. The caveat there, I guess, there's two. One is any expenditures that you make before you get the loan proceeds don't count as qualified expenditures. So you're purely fronting this period of time before you get the loan on your own working capital. I work with a lot of contractors, and most of them, if they're kind of in that boat, they've laid people off, and then the intent is as soon as they get the loan proceeds, they're going to bring them back and use these proceeds to keep them on the payroll.
Okay. What are you hearing about banks preparing their own individual applications? We are hearing that the Form SBA application will not be accepted.
I haven't heard that banks are going to prepare their own form, but I believe they'll use the SBA form, but they might want it. If they're doing a straight online application, they're going to use a fillable form online where you can type everything in. They don't want you printing it and filling it out by hand and scanning it back in. So I believe the loan application is the loan application. It just might be you have to fill it out online. They don't want you, printing it, filling it out by hand. What definitely can differ bank to bank is the support that they're asking for and what particular payroll reports they're asking for to underwrite the loan. Okay.
Does reducing staff pay by 50% reduce the amount of PPP a non-for-profit is eligible for? We do have no layoffs here.
So there is a provision in the bill that if you reduce wages by more than 25%, then it would begin to eat into the amount that was forgiven.
Okay. What is the impact of a business that is owned by a small group of EU investors?
That's an interesting question that I don't know off the top of my head, and we will definitely get back to you on.
Okay. Does the employer have to maintain some employees for a period of time after the loan has been granted in order to qualify for a loan forgiveness?
Yes, we did cover this, but they're going to take a head count during the 60 days post-loan proceeds, receiving the loan proceeds, and compare it to that period before you got the loan.
We have PPP paperwork ready to go and have put 66% of the company on furlough to protect cash flow right now. What considerations are there?
I think with that, make sure you check with your bank to make sure that you've got all the appropriate supporting documentation that they want. And then, again, after you get the loan proceeds, you're going to want to bring people back. Even, again, I work with a bunch of contractors, so I have people that are going to put people back on the payroll that aren't necessarily going to be doing anything, but they're going to be on the payroll, and you need them on the payroll to make sure you use up the proceeds on qualified expenditures.
Okay. If you have a non-essential business, are you supposed to pay your employees right now in order to qualify for the loan and not have to pay it back? Or do they go on in unemployment and you just need to rehire when you go back to work?
Correct. Yeah. So the second part of that is I think we've covered a couple times. So they'd be on unemployment now, and you just have to make sure you bring them back during the 60-day period. Remembering that, if you bring them back a week or two in, it counts as if they were there the whole time. However, if you're not paying payroll on them the whole time, you might not have enough qualified expenditures. So you're probably going to want to bring them back kind of at the beginning.
Okay. A couple of questions here regarding banks. Do we know what banks in our area are offering PPP loans? And uploading applications, do you go to the SBA or to the bank?
Most of your larger banks are going to be offering this. I know just in the banks that we've talked to, Chase Bank is, Community Bank, Key Bank, M&T, Tompkins, Watertown Savings Bank if you're up north, they're going to be, and I'm sure there's others that I'm not thinking of. But again, it's any SBA approved lender currently. The SBA has said they're going to try to roll this out to other lenders that are not currently SBA approved. That's probably going to take a couple of weeks. And the whole loan process, although it's administered by the SBA, it's going to be through your local bank. So you're not going to upload anything to the SBA. It's going to go directly to a bank.
Okay.
And
the
the bank,
payroll calculation. Oh, sorry, go ahead.
And I just say, a lot of the banks we've talked to have said, as I've said, are going to take care of their clients first. So you're going to want to apply at your individual bank.
Okay. Does the payroll calculation include all employees, or do we have to exclude high wage earners?
It includes all employees, but you have to exclude wages over $100,000 per employee. So if you got 6 guys making $120,000, you lop off $20,000 from each of those.
Okay. During your presentation, were you saying that self-rental rent payments will not count if they have a formal lease agreement due to related party?
I do believe if there's a formal agreement, it should count. What I was saying, what I was alluding to there was if it's an informal month-to-month and there's no documentation for it, that's not going to count because at the end of the 60-day period, you get the loan forgiveness. You're going to have to submit proof to the bank that you had these qualified expenditures. And one of the things is, you're going to payroll reports to lock in the wages paid, rent bills to substantiate that. The agreement for the rent has to be dated before 2/15/20. So you can't put a new rental agreement in place today and have it qualify. It has to be something that was in existence before February 15th. And then, any utilities that you're claiming for qualified expenditures, you'd have to submit invoices to support those disbursements as well.
Okay. Can I include the wages of a non-U.S. employee not living in the USA within the equation, understanding that I cannot pay the individual compensation?
Wages paid to non-U.S. people residents are excluded. So I believe the answer there is going to be no, because you have ineligible payroll costs for the calculation include compensation of employees whose principal residence is outside the United States.
Okay. Can the employer/owner of a LLC include up to $100,000 for each owner to compute average payroll?
So this is a question that I had this morning, and I'm assuming what this question is getting at is the LLC owners are not eligible to be on payroll. They get weekly draws, so it doesn't run through any payroll. There's no withholding taxes and whatnot. The way we're reading the law, it does not appear that way. So we've even had conversations within our firm, because we're an LLC, that the draws that the partners receive aren't going to be includable or wouldn't be includable in this calculation. So unfortunately, as I understand it, I don't believe the draws that a partnership or an LLC owner takes is going to be allowable here.
We have a medical practice that is applying for advanced Medicare payments from CMS. Is this a same purpose application or duplicative to prevent us from applying to the SBA loan?
I cannot answer that off the top of my head. We will have to get more information and respond to that later.
Okay. Can an employer, example would be with 18 full-time equivalents, also include the cost of a 1099 contractor? Example, three recurring monthly contractors working part-time in the average payroll cost.
Yes. So if they would otherwise be considered compensation if they weren't independent contractors, yes, those costs can be included. The 1099s that can't be included are like your vendor costs.
Okay. Can you repeat if you said that a business with no employees can apply for this, or is it only if you have employees?
So if there's no employees, I'm assuming this is a sole proprietor, and there are provisions made for sole proprietors. It's based on essentially it would be the fees or revenue that you collect on a monthly basis up to $100,000 for a year.
Could you expound on payroll costs and identify if payments to 1099 subcontractors can be included?
I think we covered that in the previous question.
Yeah.
If the 1099 that would otherwise be considered compensation wages, yes.
For the employee test, what number do you use if employees increase or decrease throughout the test period?
It's average full-time equivalents.
Okay. If restrictions prohibit full business operation, can we still bring all employees back?
Hang on one second, Bill.
Good.
Yeah. All right. I'm sorry. I was just checking my last answer. It is full-time equivalent. So go ahead. What was that question?
Yeah. If restrictions prohibit full business operation, can we still bring all employees back?
Yes. You would just pay them to essentially do nothing. And, that's a defensive move to keep the employees on your roster so that when, the switch is flipped and the economy turns back on, you pull the people off your bench and get back to work.
Okay. Do they have to be the same employees that I bring back, or can I hire someone new?
I do not believe hiring somebody new would go into the before and after test, like the headcount test. Hang on, getting clarification.
Okay.
All right. So for those of you that don't know, my wife's also a partner at the firm sitting next to me and giving me the evil eye. So I'm going to modify the last answer. She probably knows this better than me, and she believes yes, that if you hired someone during the 60 days after, they would count.
Okay. The company portion of RRB taxes are not included in payroll costs, ? Do you need to maintain a separate account to prove usage of funds?
So this is a railroad question. We're gonna
pass on that.
Repeat the question. No, I'm not gonna pass. I'm gonna make Nicole answer. Repeat the question.
Okay. If they're, oh, hang on here, I just lost the question here. Let me come back to that. Oh, here it is. The company portion of RRB taxes are not included in payroll costs, question mark. Do you need to maintain a separate account to prove usage of funds?
So it almost seems like a two-part question. So the employer taxes, the RRB employer taxes should not be included as part of the gross wages that's coming up with this, and they're also not allowed to be included in the payroll cost calculation, the employer portion. And then as far as keeping separate, it's up to each company if they want to be able to track the expenses to be able to prove it at the end. They can keep a separate bank account, but at the end you still have to prove the expenses that you paid for it. So whatever is easiest for each company to be able to prove that.
Okay.
Hopefully that answers
Next
that
question. Next, given the attractive interest rate, why not use additional funds for non-forgivable expenses?
Yeah, so one of the things that in the application is that you're certifying you're going to use the funds on qualified expenditures. So they're expecting the vast majority of the loan proceeds to be used on qualified expenditures. If you get the loan and then don't pay any wages, there's going to be repercussions, I would imagine.
Okay. How quickly are the loans expected to be granted? Are they going to be mailed or direct deposit into our account?
That's a fantastic question, and I wish my magic 8-ball had the answer. The idea behind this is it's supposed to be quick, but there's really no guidance for the banks on that yet.
Okay. When you calculate the state or local tax of EE compensation in the eligible payroll costs, do you only mean state unemployment costs?
We're thinking.
Can you repeat that again, Bill?
Sure. When you calculate the state or local tax of EE compensation in the eligible payroll costs, do you only mean state unemployment costs?
All right. We're going to respond to that one via email.
Okay. Are group life and dental insurance included in health benefits?
That would be negative. Just the actual health insurance.
Okay. Do you have a sense of what will be required for self-employed individuals to provide for proof of income, especially if they're not paid through payroll?
My guess is bank statements, because that's going to show the cash coming in. But that there's been no guidance from the banks on, because they've been so wrapped up in the small business portion.
All right. If you get the loan, do you just use it like a bank account? And if you don't use the amounts, then they just sit there?
Yeah, I mean, it's going to be deposited into, my guess is it's going to be a direct deposit, and it's going to be deposited into your bank account, and you're going to use it for qualified expenditures. And if you don't use it, yeah, the balance would be there. And someone has, to go a little step further, someone had asked me yesterday, well, if I end up not using all the expenditures, or if, I guess that was a question. If I don't have enough qualified expenditures and I'm left with a portion that's supposed to be a loan, can I just use the remaining proceeds to pay the loan off? And the answer is yes.
Okay. You mentioned the 60-day post-loan proceeds measurement date for loan forgiveness measurement, and in parentheses, qualifying spend and FTE ratio. Is there a requirement that the FTEs remain in place through 6/30/2020 program end date, or just through day 60 measurement date?
They're just measuring during the 60 days after the loan. So if the question is, can you fire everyone on day 61? They're not measuring past day 60. But Bill, the thought there is that this loan should get you through 2 months, and they're hoping by then the economy turns back more to normal, and you're going to need those employees, and so you would keep them on the payroll.
All right. Do we need to include all our employees, or can we limit to certain sections?
I'm assuming this question relates to who you have working during the 60-day period. Well, let me answer it like this. Your max loan is going to be calculated on your average payroll that's going to include all your employees. If for some reason you don't want the max loan, you could take less and you could pay less employees, but getting the max loan and paying all your employees is kind of the heart behind this program, because they want your employees to be on your roster and ready to go, even if you don't necessarily have anything for them to do right now, so that they can get back to work as soon as the economy's turned back on.
All right. How does the loan get calculated for someone with no payroll other than the owner?
I think we've touched on this. If you have no payroll and all you're doing is taking draws, well, if you're an LLC and you're only taking, all right, I'm sorry, Bill. This sounds like it's going to end up in the sole proprietor bucket, and I believe there hasn't been a lot of guidance on this, and I believe that's going to be based off of basically your bank statement and the cash flow coming in limited to $100,000.
Okay.
Or 1099.
Any interest on loans is a qualified expense. For instance, equipment loans?
No, it's mortgage interest primarily. But like your auto loans and equipment loans, I don't believe are covered as a qualified expenditure. Mrs. T is saying, hold on, and she's flipping through the bill. What I'll say on that is most banks are offering some kind of forbearance. Okay, I stand corrected, which is a regular occurrence. It's interest on any other debt obligations, including mortgages, that you had in existence before the covered period, before 215. But I would say that most banks are offering some kind of a forbearance program to get deferment on principal and interest payments. And so it might behoove you, if you're having issues, cash flow issues, to contact your lender and see what programs they have in place. So you might be able to get I've heard some banks offering up to a 6-month deferment of payment and principal and interest.
Okay. We have some staff that are still working from home and some who are not. Can we apply for just the folks we're keeping on staff who cannot work from home?
I suppose yes, but again, it would make more sense to apply for everyone and then even pay your people that are continuing to work, out of these proceeds as well.
Okay. I assume companies with workers paid as K-1 partners would not qualify. Can the individual partners apply individually?
That's an interesting question. I'm going to say I don't believe so, because they're not a sole proprietor. They're a partner in some kind of a company. Again, that goes back to, I think, a question we answered earlier. This is really driven off of payroll. So it unfortunately kind of excludes those type of earners.
Okay. The application asks for a company representative and the owner to sign. We are a nonprofit, so there is no owner. Is it okay only for the director to sign the application?
So the director, I believe in that situation, yes, the director would sign it. Your representative could be anyone that assists you in preparing the application, which could include your accounting firm.
Okay. Can you discuss the affiliation rules associated with this? We have common ownership between a company that has over 500 employees, but our company has under 50. Are we excluded?
I don't know those rules well enough to speak to them over the phone. We can definitely get an email answer to that. But what I do remember is it was based on physical location. But let's come back to that question via email.
Okay. Any idea of how long it will take to get these loans approved and how long we can delay taking the loans so that we have time to get employees back?
So I think I touched on the first part. It's supposed to be a quick process, but banks are going to be inundated. So I got to imagine there's going to be some backlog. And the program's available through June 30th, but you need to remember that there's $350 billion allocated to this, and I do believe once that $350 billion is gone, this program, unless renewed, would be gone. So we're encouraging people to apply sooner rather than later, as well as so is the guidance from the Treasury Department.
Okay. Is the 8-week period from May 1 to June 30th, or does the 8-week period begin the day the loan money is deposited into my account?
The latter, 60 days from receiving the loan proceeds.
Okay. Must the employer show and define a specific economic loss, or just that the business has been affected by this situation?
You just have to attest or sign that you've been affected. There's no particular measurement where sales have decreased X% or anything like that. And that's why I said I don't believe, maybe outside of grocery stores, I can't see too many businesses not being affected by this.
Is there an issue if we reduce employees to 32 hours a week versus 40 hours a week? About 80% of our employees are hourly.
An issue in general, no. You may have a problem coming up with enough qualified expenditures. So you may want to just pay them for 40 and only have them work 32, since the proceeds for those extra hours are going to be coming from the loan.
Do we owe workers' compensation while employees are at home?
That's an interesting question. I would think the normal, this is me thinking, I would think the normal workers' comp type payments would be due, even because they're on your payroll. You're just getting funding through the government to pay them. So I would think your normal insurances would still have to be paid.
Okay. Can you talk a bit more about how applying for this will affect other SBA applications at this time?
Mrs. Teska can.
If you already had applied, so there's another emergency disaster loan program under the SBA, and if you've already applied under that and received the proceeds prior to tomorrow, essentially the date that the PPP program is available, you have the ability to roll that into the PPP program. You also, if you don't want to roll it in, our understanding is you can also still qualify for the PPP program. Otherwise, you can't have usually two. The PPP program is under the 7A of the Business Administration. You can't have two 7A loans out at the same time. So if you already have the other loan for the emergency disaster loan, if you already received those proceeds, you can still apply for this, but that's the only exception to that rule. So if you have another one, we're not sure if you can still apply for this. However, if you do have another SBA loan, there is a debt relief program that the SBA will make 6 months worth of payments on your principal and interest. So they're making that available to people that might already have an SBA 7 loan out already.
Okay. Giving a simple example here, if my gross salary pay is $100,000 and there was $10,000 in federal withholding, should the federal withholding be subtracted to arrive at $90,000 as the payroll cost for that person?
I'm going to say there's ambiguity in the way the law is written on that.
Okay. This might go along with the SBA loan question we just had. Will an economic injury disaster loan negatively affect my PPP application?
Correct. So that was kind of what I answered before. If you already have one outstanding and you've already received the proceeds, the law says you can still try to qualify for the other one, and you can also roll it into the PPP, which will therefore give you a lower interest rate than what the current economic disaster loan gives you, which is either 3.75 if you're a small business or 2.75 if you're a non-for-profit.
However, you have to have different qualifying expenditures for those two loans. So you can't double dip saying, I'm using payroll from the same period to qualify for both loans.
Do mortgage payments qualify or only rent?
Interest on mortgage would qualify, not the principal. And you can't prepay any expenses. You can't prepay rent, interest, utilities. It's just what's currently due.
Okay. What if a couple of employees elected not to work and they get replaced with newly hired employees? Do the newly hired employees qualify in the head count?
Yes, it's a full-time equivalent count, so yes.
Okay. We have prevailing wage and union employees. Do we only pay base rate during this time?
So this is a great question. So your loan value is going to be based on the 12 months preceding the loan. Presumably, that's in that you've paid prevailing wage. So your loan value is going to be pretty high. Let's just, for conversational purpose, we're going to say it's $50 an hour. If your base rate is only 25, you're probably going to end up with not enough qualifying expenditures to get the whole amount forgiven. So you might need to pay more than the base rate, or end up with an amount that's not 100% forgiven.
Are part-time employees covered, and if so, do we calculate their FTE as a percentage of the head count for the head count calculation?
Yes and yes.
Okay. We rent cottages. If we can cover our costs initially while opening, in other words, no real loss, does this program apply?
Right. I mean, it's based on payroll, and you have to attest to the fact that you suffer. There's been some kind of economic effect from this pandemic. So if your rent rolls are down, then yes, you'd be able to apply. Again, it's based on payroll. Unless you're a sole proprietor, in that situation, it's going to be based on the income coming in off of that, in which you would still be able to apply. Are
draws included as wages or only W-2 income?
Unfortunately, just the W-2.
Okay. To clarify, it sounds like if you have 6 employees making $150K, you can include $100K of each of their earnings, correct?
That's correct. So you'd have, your bucket would be $600,000.
You mentioned we cannot include payroll taxes. Can we include SUTA acronym taxes, SUTA taxes?
state taxes are allowable.
I'm a sole member of an LLC. I get paid hourly like all my employees. I'm assuming I would qualify for this. I have weekly wages which are taxed like any other employees.
If yes, you get a W-2 at the end of the year, the answer is yes.
Okay. Does our head count include all employees or only full-time employees?
Full-time equivalent. So again, 2 20-hour people make up of one full-time person.
How will I get employees to agree to stay on payroll with the unemployment rate plus 600 right now?
Great question. The employee certainly has the option to not go back on payroll.
Yeah. We are a sales agency and pay bonuses at the end of the year based on commission earned throughout the year. The average monthly payroll for the last 12 months will be larger than the current payroll. Should we raise pay during the 8 weeks to match what the last 12-month equivalent salary would be if we get the loan?
Well, the loan value includes the commissions that you're talking about, so those would be included. However, again, it's going to be limited to $100,000, and so per person. So if your commissions push you over that amount, it's going to be cut off at $100,000 per salesperson. And as far as the payout, I can get back to you on that for certain. However, I do remember there is a clause about you can't increase wages over a certain amount, and the wages during that period have to be prorated to be not more than what would be $100,000 salary. So there's not a lot of flexibility in there.
Okay. Well, we've run up through our time period here. We've made it through about, I would say, 85% of the questions. What we'd like to do is we have a report of these questions, and we'd like to email back the remaining ones that we didn't get to get to. And I want to thank you all for joining us for our webinar today. I also wanted to remind you, most of you that signed up probably got an email with a dual invitation on it. And tomorrow at 2 o'clock, we'll be covering the tax provisions, both individual and business tax provisions of the CARE Act. And I hope you all can sign up for that and join us for that. So with that, Bob, thank you very much. And thank you, Nicole, for jumping in too. And thanks for all of you for attending this webinar.
Thanks, everyone.